Good morning, everybody. Welcome all to the second talk in our series on the IMF's capacity development work. Today, we will focus on debt and debt management and fiscal risks. As many of you know, our work in this area is coordinated closely with the World Bank and supported through the Debt Management Facility, a joint IMF World Bank Trust Fund, of which I am the co-chair. But today we want to focus on the IMF's work to help countries strengthen their capacity to monitor and manage debt and to deal with the attendant fiscal risks. And as we will see, transparency is shaping up to be an overarching theme. To discuss this, we've assembled a panel of eminent experts from across the IMF. We'll briefly discuss work that they are doing with member countries to help them deal with these risks. We're also happy to have with us a practitioner whose job it is to manage debt on a daily basis. I will introduce the speakers in turn before they take the floor. We will have time for Q&A at the end, so please use the Q&A box to send in your questions throughout the session. But before we start, allow me to say three things. First, there is no doubt that debt issues are topping the agenda this week, and you will surely be hearing much more about it as the annual meetings unfold. For many low-income countries, debt levels had already reached worrisome levels pre-pandemic. COVID-19 and the resulting economic shock has made things worse. Second, the international community has taken several welcome steps to mitigate this shock. The IMF itself has cancelled debt service for a 12-month period to provide relief to low-income country finances. And we have been working closely with the G20 and its DSSI, the Debt Service Suspension Initiative, which also provides much needed relief. And during these annual meetings, we will continue to work on these issues. But third, beyond the much needed liquidity support, there is also an urgent and indeed rising need to strengthen national capacity. And that is what this seminar is all about. So with no further ado, let's start. First up is Marcos. Marcos, the floor is yours.
This pandemic, in a sense, created a perfect storm for debt vulnerabilities because it combined a collapse in activity, a collapse in revenue, a very large increase in expenditures as countries were fighting the pandemic and trying to support their economies, all of which go in the direction of affecting key drivers of the dynamics and making that increase. And in the case of some emerging markets and low-income countries, the shock was compounded by higher borrowing costs. As this chart shows, the general government primary balance, we see a very sharp deterioration across the board by income groups. The blue line is the median for advanced economies, the red line for market access emerging markets, and the green line for low-income countries. We see deterioration in all of them, but a much sharper deterioration in advanced economies. And this is in part because these countries had more fiscal space to respond to the pandemic. One of the reasons why deficits are not as high in low-income countries is because they did not have as much fiscal space. They had a much more constrained response than their advanced economy counterparts. Moving to the next slide, we can see that despite this smaller deficits, we also see an increase in debt across the board. And again, this is plotting the medians, same color scheme as in the previous chart. And the shaded areas indicate the interquartile range. So we see an increase across the board on the median, but if we look at the tails of the distribution, some countries that were already at a high level of the distribution, that move over to even higher levels. And what is interesting to note is that when we look at the forecasted period, which is to the right of this dashed line, we see that there's a significant increase in that, and that is projected to remain high throughout the forecasted horizon. So the shock, the fiscal side is meant to be a temporary one. We expect countries eventually to return to a level of fiscal balances similar to the ones prior to the pandemic. But on the debt front, we see more of a step increase. So that is going to remain relatively high going forward. And in the particular case of LICs, which is the focus of this talk, we do see that that was already at relatively high levels before and will remain at levels that are fairly high when we consider the post-HIPIC period. As we turn to the next slide, we see is that this slide gives you the risk assessments of that distress based on the LIC DSA. It covers how these risk assessments have changed over time since 2015. The green indicates the share of the low risk assessments, yellow moderate, red high risk, and the gray bars are the share of countries that are already in that distress. And what's interesting from this chart is that we see an increase in the share of the red and gray bars, which are the riskiest categories over time, but we do not see much action between 2019 and 20. So that the risk of that distress was already high. Around half of the countries already were considered to be either in high risk of that distress or already in that distress. But so far, there hasn't been much of an uptick from 2019 to the latest data. And that is surprising and in a sense better than what we might have hoped for in the depths of the shock back in March. And here I think that part of the reason was unprecedented efforts by all parts, including by the IMF and the World Bank, working together with G20 bilateral creditors in the early stage of the crisis in an effort to make sure the countries maintain some access to finance and address at least the liquidity dimension of the crisis. So if we could borrow an expression from epidemiologies, we have succeeded in flattening the curve. And this is important because it buys time, but we have to worry that there are still underlying that vulnerabilities that still need to be tackled, because these vulnerabilities already predated the pandemic. And addressing these high debt vulnerabilities will involve a combination of adjustment measures and other efforts to restore growth. Some of the capacity development that will be discussed during this presentation will be part of that effort. But there will be cases where that is unsustainable, even taking this effort into account, and where a restructuring will be needed. And now I turn to my colleague, Peter Brouwer, to continue the presentation. Thank you.
Thank you, Marcos. Against the background of these significant debt vulnerabilities, some of which already existed before the pandemic, when the crisis hit, we in the Monetary and Capital Markets Department set out to understand exactly what are the needs of debt managers in our member countries and how can we help them. So we first set out to write a note in the IMF's COVID-19 note series on debt management responses to the pandemic. This note provides guidance on areas in which sovereign debt managers may need to respond to the challenges stemming from the crisis, i.e. the sharply increased government financing requirements and higher borrowing costs, at least initially in the crisis. Debt managers can help cushion liquidity shocks, for example, by minimizing near-term liquidity risks, meeting rollover needs, and supporting an orderly functioning of primary and secondary markets. So this note provides a menu of actions that sovereign debt managers can consider in order to adapt to these new circumstances. We then use this note in order to engage with sovereign debt managers in regional roundtables in collaboration with the technical assistance centers and training institutes that the IMF collaborates with. So we had events, various events in Africa, in Southeast Asia, Eastern Europe, and the Caribbean. Some of the key takeaways from these engagements were, and again, this is early in the crisis when the G20 debt service suspension initiative was still being discussed, but there were clear concerns about the implications for their credit rating from participating in this initiative. A second concern was for many countries whose main creditor was not actually a member of the Paris Club, they were concerned whether non-Paris Club official creditors would be participating in the G20 DSSI. And some of the concerns that they discussed with us, the sovereign debt managers, was the immediate concerns for mitigating refinancing risks and to rebalance the debt portfolio composition in the current situation. They also had an eye on the medium term and considered the implications of COVID-19 for debt management strategies and annual borrowing plans. So our capacity development focused on those needs. We paid particular attention to revising debt strategies, to implementing new annual borrowing plans, the refinancing of international bonds, improving the frameworks, the market frameworks for primary and secondary markets, as well as investor relations and debt reporting, and in particular for countries participating in the DSSI, debt transparency is very important. We also engaged with countries that were in discussions with the International Monetary Fund in order to obtain financing, where debt management would be an important part of their commitments for their framework. Often, for example, designing and publishing a medium-term debt management strategy may be part of such engagement, and our capacity development was there to help. And finally, we also engaged with countries in debt distress that may require support on debt portfolio risk analysis and debt data reconciliation. We have here with us today Sona Nufsanjor, the head of financial markets and insurance at the Mongolian Ministry of Finance. He's joining us from Ulaanbaatar to give us an example of one of such engagements, a technical assistance mission to Mongolia on a liability management operation that took place during the pandemic. And I hope his technical problems are resolved. Sona? Yes, excellent. Thank you.
Great. Yeah, I had to join in from my phone. Apologies for the earlier technical difficulties. Now, allow me to introduce myself. My name is Toner, Director at the Ministry of Finance. So I led the recent liability management transaction that was conducted by the government of Mongolia on the international capital markets. So the transaction was done purely to refinance the upcoming maturities in 21 and 22. Now, to start off with the IMF TA, now we started the dialogue with the IMF's rep office in Mongolia back in last year. And we were supposed to start the technical assistance mission earlier this part of this year, but due to the COVID-19 pandemic, we had to postpone it and conduct it in June remotely. It was a different, because of that, it was a little bit of different type of mission than the previously, where there was an official visit to Mongolia by the IMF staff and the technical experts. Now, the one particular area of this mission that we really enjoyed was it was very hands-on approach. So it was just not the technical information that was provided, but actually the experts were able to communicate with our staff much more on the hands-on basis. So we could it could be applied to real life scenario and real life transactions, what actually happens on the ground. So it was just not only the theoretical part. And during the sessions that I was engaged in, for example, when I asked about the use of New York law versus English law in a 144A transaction, or use of collective action clauses in the sovereign deals. All of the technical experts were able to provide very detailed and granular information that was helpful to when we actually did the execution of the transaction. And on the next slide, so here you can see the details of the of our recent bond issuance. That was for the liability management. So just to give you some highlights, the overall size of the transaction was $600 million US. It was a five and a half year transaction where we achieved a coupon of 5 1/8%. Now, our credit rating is currently a single B, stable by S&P and Fitch. And the use of proceeds was to 100% refinance the 21 and 22 maturities. Now, three main takeaways from this were, first, it helped us to increase the maturity of our debt profile and the extended duration. So because we were able to refinance majority of the 21s and a portion of the 22s, now our on average the duration is longer now. Second part highlight I want to mention is that we were able to reduce the running cost and the debt service. So our 21 bonds, the coupon on those bonds were 10 and 7/8%. So it was a very high coupon sovereign bond. In terms of the 22 bonds, the coupon rate was 5 1/8. So it was the same coupon as this bond that we just issued. So on average, it helped us to reduce the running cost of our debt service in terms of the coupon payments. And third thing I want to highlight is during the bond issuance and after the transaction was done successfully, we've communicated this to the credit rating agencies and to the general response we got from the investors and the rating agencies was very positive. So rating agencies have mentioned, specifically noted that this is a credit positive event where it has elevated certain liquidity pressure that we've had in the upcoming years. So in their next sovereign assessments, they will take a careful consideration. They will consider this a credit positive event. On this transaction, we've worked with the 4 investment banks, HSBC, JP Morgan, Morgan Stanley, and Nomura. Now, in terms of the investor base, we've so majority of the investors were from the United States and the Europe, and over 10% were from the Asia. Over 90% of the investors who've participated in the transaction were asset management firms, 3% were pension funds and insurance companies, and 3% were brokers and dealers. Now on the next slide, could we move to the next slide? Thank you. Of course, because of the there were certain challenges when we were transacting this deal. Of course, the COVID-19 pandemic and the overall global affairs had a negative impact on the overall market sentiment. So COVID had an impact on our fiscal accounts, on the balance of payments, on our reserves. So investors did take a look at those. Also, in general, there are certain market events that investors took into consideration, like the US elections, Brexit, US-China trade war. So these market events are creating a lot of noise in the market where it impose certain uncertainties of the, for example, how the US policy will go forwards and what will happen with US-China relations. And also Mongolia was included in the Financial Action Task Force's gray list on the anti-money laundering and terrorist finance. Investors also asked certain questions on that, but we've already achieved all the necessary steps to be delisted from the FATF's list. So yesterday there was a meeting of the FATF meeting where there was a decision to remove Mongolia from FATF's list. So these were some of the considerations we had to take when we were transacting this bond. Now, I was given only 5 minutes to go over the transactions, so I understand there is a Q&A section in the end, so I will stop here and give it back to you, Peter. Thank you.
Well, thank you very much, Sonar. That was very interesting, and I hope we can come back to you during the Q&A. Let's move on to Amanda Sayegh from our Fiscal Affairs Department, who's going to talk about the IMF's work on fiscal risks. Amanda, the floor is yours.
Thanks, Roger. Understanding fiscal risks and their potential impacts for public finances is important for managing debt vulnerabilities and ensuring debt sustainability. And this is particularly the case for contingent liabilities. These are obligations that governments enter into today that may have no upfront cost, but can increase debt in the future if a specific event occurs. Experience tells us contingent liability realizations can be very costly, occur surprisingly frequently, and are highly correlated with each other, as you see here in the chart on the left. These risk realizations have had an average fiscal cost of about 6% of GDP on average. Events of the past year have further underscored how quickly fiscal risks can knock public finances off course. The COVID-19 crisis has triggered the largest fiscal risk realization since World War II, causing government debt to increase substantially from earlier expectations, as you see here in the chart on the right. In addition, the various fiscal measures implemented by governments in response to the crisis have further built up risk exposures. Now, at a time of heightened uncertainty and ongoing policy challenges, it's even more important that governments invest efforts in understanding fiscal risks and their potential to crystallise. That's why the IMF's Fiscal Affairs Department has been working closely with countries to help them better identify, quantify, and manage fiscal risks. As you see here in the next slide, we have developed and are enhancing our fiscal risk assessment toolkit. It comprises practical Excel-based tools to help countries assess the fiscal implications of various exposures. I'll just talk about a couple of these tools. The fiscal risk assessments help countries to identify the scale and sources of their fiscal risks and chart a course of actions to mitigate and manage them. Balance sheet assessments help to compile and assess risks to public sector assets and liabilities in a comprehensive way, helping to identify vulnerabilities and interlinkages across the public sector. Now, state-owned enterprises have been a significant source of risk in many countries. They've often accumulated large liabilities, sometimes backed by government guarantees, and troubled enterprises have given rise to large fiscal costs in the past. So 2 of our newest tools have focused on assessing risks related to this sector, each tailored to different country capacities. A health check tool, which is already being applied in several countries, examines a set of financial vulnerability indicators to flag those entities that are higher risk and may require more intense monitoring or targeted interventions. And a second stress test tool that tests the resilience of entities' cash flows under different economic scenarios to examine the impact on their liquidity, ability to service debts, and the potential impacts on government finances. In addition, we have specific tools to help assess the fiscal costs and risks in public-private partnership projects, and we're working currently to develop similar tools for public loan and guarantees. Now, finally, the Fiscal Affairs Department's been working with countries to conduct fiscal stress tests. Now, similar to stress tests used in the banking sector, these are aimed at stressing public finances to very large and severe shocks, including pandemics. We've recently added a new COVID-19 module that looks at the macro fiscal impacts of alternative health and containment scenarios. So by better understanding risk exposures and their potential costs, governments can make more informed policy decisions, can better manage their risk exposures, and importantly, can ensure that the potential implications for fiscal policy and debt sustainability are considered. In the past few years, we've worked with more than 100 countries, particularly low and middle income countries, to help build capacity to identify, quantify, and manage fiscal risks. This has been through diagnostic assessments, targeted capacity development missions, regional workshops, and online courses. Efforts have focused in particular on strengthening institutional arrangements to monitor fiscal risks, training officials in techniques to quantify them, and enhancing reporting and disclosure, recognising that transparency can go a long way in supporting stronger mitigation. During the COVID crisis, we've worked with countries remotely to help them assess the macro-fiscal risks associated with the pandemic, vulnerabilities it may have caused for state-owned enterprises, and to assess the fiscal costs and risks of new public guarantee schemes that have been introduced in response to the crisis. In addition to our analytical tools, we've prepared various notes that provide guidance for policymakers on how to manage various sources of fiscal risks, and we'll be adding to these in the period ahead. Our capacity development work over the past few years have helped countries to prepare quantified fiscal risk statements, enhance risk registries, develop methodologies to assess specific types of risks, and to strengthen legal and institutional frameworks for managing them, particularly for public-private partnerships and state-owned enterprises. We'll continue to develop our tools and guidance to help policymakers better understand and manage risks, and we stand ready to support countries in their efforts to further strengthen fiscal risk management practices and the resilience of their public finances. Thank you.
Thank you very much, Amanda. Let us turn now to our statistics department, and we have with us Clément Couty, who's going to talk about the importance of boosting transparency in public debt statistics. Clément, the floor is yours.
Thank you, Roger. Let's first start by hearing what policymakers and data users say about debt transparency.
Debt transparency has indeed become a very interesting and hot topic.
You know, we have had to come up with what we refer to as the medium debt strategy.
Georgia is a small open economy, and I think that proper debt management cannot be done without having transparent and high quality information.
The international agencies, the rating agencies, actually trust the information that we produce because of the level of transparency we have had in Uganda on debt.
So debt transparency is a prerequisite to prevent crisis and to react properly in such crisis, and if possible, do things, to have a good understanding where a country stands.
As we've just heard, transparent and high quality data is important for proper debt management and helps to have a good understanding of where a country stands to prevent crisis or react appropriately in the event of a crisis. Our debt statistics capacity development emphasizes availing more and better quality data statistics for broader institutional coverage and instrument coverage that is used first by fiscal policymakers to assess fiscal policy, debt sustainability, and fiscal risk. But it's also used by the IMF for surveillance purposes, including for the preparation of debt sustainability analysis. And finally, the public to improve transparency and accountability. Our recent capacity development has contributed to improve the institutional coverage of debt, to include debt of entities not previously included in countries like Cabo Verde, Zimbabwe, and Cote d'Ivoire. Capacity development has also supported including debt instruments that were previously not included in Liberia and Moldova. The focus of our debt statistics capacity development is to address the major data gaps our member countries have identified, and we put an emphasis to help improve transparency in the most vulnerable countries. As you can see in the following slide, in the graph on the right panel, since 2018, 51% of countries invited to our workshops were in debt distress or at high risk of debt distress, while 60% of countries that benefited from technical assistance were in debt distress or at high risk of debt distress. The lack of coverage of state-owned enterprises' debt came out prominently as an issue for our member countries in diagnostic workshops that we conducted, as you can see in the graph on the left panel. This was also reflected in IMF research that showed that state-owned enterprise debt levels can pose a risk to the public sector and are the root cause of hidden debt and debt vulnerabilities that in turn reduce the actual fiscal space for other spending, which is particularly problematic during an economic crisis. Research has further shown that limited transparency of state-owned enterprise operations and their financial relations with governments increase the likelihood of misuse of state-owned enterprises for off-budget spending and borrowing. Our capacity development targets, as you can see in the following slide, lower and lower middle-income countries from around the world with an emphasis on the sub-Saharan African region. The Debt Statistics Capacity Development Toolkit blends different activities that help improve debt quality and transparency. Our traditional capacity development includes diagnostic workshops and follow-up country-tailored and risk-based technical assistance. On the one hand, the diagnostic workshops help identify policy-relevant data gaps and steps to address debt data coverage and dissemination for improved transparency. The workshops also provide participants with the opportunity for peer learning to raise awareness of the merits of improved transparency and how other countries have tackled reform steps. We have so far conducted 4 workshops and plan an additional 4. On the other hand, technical assistance missions aim to address specific issues on data quality and coverage that has a substantial bearing on macroeconomic management, but also help with improving the frequency and timeliness of data dissemination. We've conducted missions to 9 countries since 2018 and plan an additional 26 in the coming 18 months, as you can see in the graph on the following slide. In addition to the tools developed to assess fiscal risk of state-owned enterprises, we've also developed a state-owned enterprise data compilation template that has been used in workshops and technical assistance. The template allows to convert state-owned enterprises' financial statements into fiscal statistics that capture flows and stocks in an integrated manner to provide an overview of key statistics and thereby improving coverage and transparency. We have, since the beginning of the pandemic, moved the capacity development delivery virtually and conducted webinars on the recording and disclosure of COVID-19 related policy interventions in fiscal and debt statistics and on compilation of state-owned enterprises fiscal statistics. 186 officials from 44 countries attended the workshops conducted with the support of the Data for Decisions Multi-Partner Trust Fund. Last but not least is our offering of online courses on government finance statistics and public sector debt statistics and short YouTube videos on the IMF micro-learning channel. The next speaker will provide more details on our online courses. Back to you, Rogers. Thank you.
Thank you, Clément, and that is indeed a good transition to our next and final speaker. We have with us Oana Kroitura, who's going to talk about our online learning program focused in particular on public debt analysis. Oana, the floor is yours.
Hello, everyone. The video has given you a glimpse into how the IMF online learning program is supporting capacity building in the areas of debt transparency, analysis, and management for thousands of government officials and members of the general public from all over the world. I would like to take a minute to discuss how we are adapting in the current environment, which has placed online learning in the spotlight. We believe that overall, we are moving towards a new equilibrium in CD delivery, which will place online and blended learning at the center. Therefore, we have considered options to make our online learning more agile and flexible. As you could see, the IMF Institute Learning channel on YouTube, launched in April this year, offers a permanent source of free, bite-sized, on-demand micro-learning videos on key issues in IMF's areas of responsibilities. Over half of the content of the channel comprises learning videos on public sector debt, which had over 10,000 of individual viewers. With the debt online courses, we are also taking a more flexible modular approach in content development and delivery. The 5 courses we will be developing in this area will be shorter and more targeted. Learners will be able to focus on individual topics of interest, combine these courses in a sequence of their choice, or pursue the whole training for debt sustainability and management. We also see great advantages in leveraging online learning in blended learning activities. By combining pre-existing asynchronous online learning with interactive training or technical assistance, our capacity development will not only be more efficient, but also more targeted to the needs of CD recipients. Last but not least, we recognize that to ensure a better understanding and absorption of content, we need to increase our training offerings in languages other than English. We will start with the public sector debt statistics course, which will be available early next year in both French and Spanish. On the next slide, I would like to focus on a specific example of recent capacity building work that bridges across different CD modalities. The Public Debt Dynamics tool has been developed and used in the context of technical assistance and training provided by the Institute for Capacity Development to country officials from the Eastern Caribbean Currency Union, Jamaica, and the African Development Bank, among others. This easy-to-use Excel-based tool is suitable for all levels of capacity. It uses about 10 macro variables to project public debt while assessing alternative fiscal adjustment scenarios. The tool also replicates the baseline public debt projections of the official MAC DSA and LIC DSF templates. The DDT is particularly relevant in the COVID-19 context, as countries are updating their public debt projections and laying out their fiscal strategies to contain and/or reduce debt levels. As you can see on the right-hand chart, the DDT can easily compute an alternative fiscal path to achieve a pre-COVID-19 debt level by 2025. Targets and adjustment years can easily be changed as needed. Given the positive feedback received, we are currently transposing this knowledge into an online course, which will be available early next year. This will foster our blended learning strategy for capacity development, where online courses are integrated alongside with training and technical assistance. Let me take this opportunity to thank our CD partners once again, particularly the DMF and D4D trust funds, as well as the government of Japan, who has generously supporting the overall online learning program of the fund since 2017. We invite our learners from all over the world to join our various capacity building opportunities. Thank you. Roger, back to you.
Thank you very much, Oana. So I'd like to take the next 10 minutes or so to address some of the many questions that have been coming in. And we probably won't have time to address them all, but let's give it a try. Was one question around the use of more high frequency indicators to give regulators a forward look on how the pandemic is evolving and how debt risks are evolving. Peter, could we start with you? From your perspective, what kind of high frequency data do you think is going to be particularly helpful during this pandemic to get a good grip on debt management?
Thank you, Roger. I think that is an important question. It obviously depends on a country's particular debt structure and how they are funding themselves, where they're getting their debt from. But to the extent that the country is borrowing in the markets, obviously the pricing is a very important indicator for the country to understand what are the conditions that it would be facing if it were to issue debt in the market now. So following market developments, also beyond pricing, of course, what's happening more broadly and globally clearly is a very important backdrop. For example, at the IMF, the Global Financial Stability Report, gives you good context at a sort of a medium level frequency, if you wish, and then we have more high frequent products. At a more aggregate level, so that's pricing, and then quantity is another very useful indicator. What are peer countries able to actually place in the market given the pricing conditions? So issuance, how far along are countries in their annual borrowing plans? Just yesterday, I think in the GFSR, there was an interesting chart on this, how some countries have already been able to finance themselves through the end of the year, while others still have some way to go in order to meet their goals. And this will help individual countries to sort of place themselves and understand, whether they will be able to meet their objectives. There are, of course, lots of other sort of vulnerability indicators. Marcos talked about some of them, but let me stop here given the brevity of time we have.
Thank you. Maybe we could ask Sonar as well, from his perspective as a practitioner. What kind of data or indicators do you follow, and do you consider particularly important for your management of Mongolia's sovereign debt? Sonar.
Thank you. So let me just clarify. So in terms of the Mongolia's case, my particular area of expertise is in the technical parts and actually conducting transactions in the international markets. And when we do these liability management transactions and other fundraising activities, whether it being sovereign bonds or other means, when we communicate with our investor community, and with the internally, what we look at it, of course, from the investors' ratings, all of them look very close attention into our fiscal metrics. Also, they look at a very array of variables. So first, fiscal. Secondly, they look at our debt, in particularly the composition of our debt, being on which currency, on the duration. Also, they very closely look at our foreign exchange reserves, whether we have savings or not. In particular, in Mongolia's case, we have a future heritage fund, the sovereign wealth fund, where we started the accumulation. Another metrics they look at is our current account deficits and our balance of payments. So, in particular for this transaction that we conducted, there was one key area that investors were looking at, particularly because of the COVID-19 pandemic. And because Mongolia is a mining country, we are in some way dependent on the mineral price fluctuations, especially in terms of copper, coking coal, gold, iron ore. So from the investor community, they also look at the global commodity price indicators that has a very big impact on our borrowing costs. Does it answer the question, or do you want me to provide more?
I think that's quite helpful. I think there were a number of questions from the audience about how practitioners look at this. Let's turn to the fiscal risks, Amanda. I mean, you've talked about all the tools that we have And I think it's quite an impressive array of analytical instruments that we use to apply to fiscal risks. Now, when we see debt levels rising already today, what do you see on the fiscal risk side? In many ways, contingent liabilities, fiscal risks of today are debt of tomorrow. Does this make you worry that there is going to be more pressure on debt levels in countries? Is that what your fiscal risk analysis would suggest, Amanda?
Thanks, Roger. Yeah, look, part of what we've seen already with the large increase in debt levels of countries over the past year, at least in the forecast for them, is in itself an expectation of fiscal risk realisation. We've seen it on the macro side and the impacts on government revenues, which has led to increased deficits and higher debt. So part of what we're seeing in that increase in forecast debt to GDP ratios is an expectation of a large fiscal risk realisation. On top of that, given the heightened uncertainty that is around in the current environment, uncertainty around the magnitude and depth of the current impacts of the pandemic and pace of the recovery, this is likely to increase risks of existing contingent liabilities and the risk that they will be realised or crystallised. And you're likely to see guarantees that may have been issued in the past in a lower risk environment might have been assessed as having a very low probability of being realised. At the moment, the risk of that realisation would be assessed at much higher. So there's potential for additional crystallisation of contingent liabilities. And in the current environment, on top of this, the policy response has seen a lot of countries issue additional guarantees or other risk-like instruments that has further added to their contingent liability exposure. So we've seen not only an increase in the realisation or crystallisation of risks, but also a build-up in fiscal risk exposures overall.
Thanks, Amanda. I mean, a lot of you have talked about the importance of transparency and of data, and a number of the questions, and many questions actually, go in that same direction. And Clément, you set out quite eloquently all the work that's being done. But what, in your experience, what's really the most important step that countries can take, and where the IMF and others can help them to build better public debt databases? Where would you start?
Thanks, Roger. The starting point is really what we had on the first slide and in our presentation, is an assessment of what is currently included in the stock of public debt. What is the institutional coverage of debt? What is the instrument coverage of debt? In most countries, particularly low and lower middle income countries, you tend to find that the coverage is limited to either the budgetary central government or the central government, and is also limited to including loans and debt securities. So this excludes debt that would be held by public corporations, but also other debt instruments that are not necessarily loans and debt securities, for example, insurance and pension liabilities, and accounts payable or arrears. So what we do when we go to a mission, technical assistance mission to countries, is first to say, look, there is more to debt than you're currently covering. And what you need to do to have a better sense of what is your total debt stock is to broaden the institutional and instrument coverage. So that's the starting point, and that's the focus of our assistance, because there are vulnerabilities arising from the uncovered or the hidden debt.
Thanks, Clément. I think that fits very nicely with what Amanda says. And if you don't have a full coverage of your debt, your liabilities, your risks, then you're likely to miss important ones. Oana, on the training side, on the online learning side, some questions about what's coming next in your program, and also whether the public debt dynamics tool is publicly available. Oana, the floor is yours.
Thank you, Roger. So So there's a number of courses that we are preparing in the area of debt. The public debt dynamics and debt sustainability tool is going to be one of them, is going to be launched in early 2021. Then we are also going to have a medium-term debt management strategy course, a public debt dynamics under uncertainty course, and the public debt investment and growth online course. They will be all launched in early 2021. Let me remind everyone that the LIC DSF course is currently available. It's been just launched a week and a half ago, so it's available for registration for those who would like to take that course. And so is the public sector debt dynamics course, and a number of other 24 online courses that we are all offering on the IMF. They can be accessed for registration on the IMF website, or for the members of the general public, they can be accessed on the edX website.
Thanks, Oana. And finally, let me go back to the beginning. Let me go back to Marcos, who gave us a wonderful overview of the landscape. Our strategy, policy, and review department is very much at the center of the IMF's work on the policy surrounding debt and looking forward. Marcos, what can you tell us about what's on your agenda and what keeps you awake at night when you worry about debt and debt developments around the world? Marcos, the floor is yours.
Thanks, Roger. We have a very active agenda on that issues. A lot of board papers and STNs coming up down the pipeline. Just to mention a few, there will be an STN on state contingent debt that should be coming out in the next couple of days. We have a lot of work on the multi-pronged debt agenda. We have work, the review of the debt limits policy. We're going to be starting the work on the lending in arrears review. We have a very active debt program, which these issues are left front and center in the work of the fund. There's a lot of concern that these issues that we need to make sure that all the tools are up to date to tackle whatever challenges may be coming down the road. So a very active program on that. And there's also the issue of that transparency that is also very much on people's minds. We had the recent paper reviewing the experiencing with restructuring private debt, and one of the conclusions of that report is that the system has worked fairly well for bonded debt, but there are some new areas of vulnerabilities coming up, including a lot of more reliance on non-bonded debt and some more opaque liability structures to which the existing tools might not work as well.
Well, thank you very much, Marcos. Well, we've come to the end of this talk. I hope that you all thought it was interesting. My thanks go to all the panelists who I think did a great job at presenting the work that the IMF does. As I said in the beginning, we're on Wednesday. The annual meetings are ahead of us, but there's no doubt that debt issues are dominating the agenda of the IMF and World Bank annual meetings. And why is that? As Marcos said, debt levels were already high in many countries, and the COVID crisis has heightened those risks. A lot of good steps have been taken, which have eased the liquidity constraints on countries temporarily. But there is no doubt that there are going to be underlying structural problems in debt that will need to be addressed. They will need to be addressed in a variety of ways. One way is to strengthen both the monitoring and compilation of debt data, their coverage, as Clément set out, the analysis of what the risks are. You heard that from Amanda. And then, of course, the management of debt levels. And that's where Peter's department comes in and where practitioners like Sona are very active. All of this needs to come together for us to be able to maneuver through what will undoubtedly be a difficult landscape. The IMF is here to help countries with that. And you heard today in which ways we can do it. We are by no means alone. I mentioned the World Bank. Has been a close partner with us throughout and will remain so. So I hope you found all of that interesting. I invite you to continue to follow our capacity development talks. We have a number coming up during the rest of this week, running into early next week. And with that, I bid you all farewell and have a nice day. Bye-bye.